Okay, let's start our meeting. First of all, good afternoon, everyone. I hope you have had a great day so far. And thank you for joining today's DLQF speaker series. We are very happy to host Dr. Eghbal Rahimikia from Alliance Manchester Business School. Before we begin, I just want to, add some quick notes. So please keep your microphones muted during the talk, and then we will have time for Q&A right after the presentation. And for those who are joining us for the first time, DLQF is the Dataism Laboratory for Quantitative Finance, and our lab brings together researchers from different backgrounds, including econ, finance, stats, computer science, data science, and we usually have this sort of guest speaker series. And today's speaker is Dr. Raim Kia, who is an assistant professor in financial technology at Manchester Business School. And he worked like in many interdisciplinary topics, including financial technology, AI, and empirical finance. And I personally know him for many years, and I'm familiar with his background and works. And I know that he used to work on, some multidisciplinary topics related to deep learning, natural language processing, and recently large language models. So I think his research in large language models and time series analysis, it's very timely and hot these days. And today's talk is titled New Frontiers of AI in Finance, Point-in-Time Large Language Models and Time Series Foundations Models for Return Forecasting. So this is a very timely topic, especially given the growing interest in how larger scale AI can be used effectively in different disciplines, including financial markets. Dr. Rankia, thank you again for joining us. The floor is yours. I think you already have.
Hi, thank you. Yeah, I just share my screen. Can you share my screen?
Yes, I think you're a co-host.
Okay, you can see. Okay, thank you so much for the invitation. So today I'm covering two different papers. Both of them are from a series of three papers I've been working on that. The next one is coming in next few weeks about synthetic data generation, synthetic text generation for, again, written forecasting. The first two papers I'm covering too, I have to cover a bit fast because there's not that much time to cover both of them in details. The first one is revisiting large language in finance, and the second one is revisiting time series foundation models in finance that just came out the last few months. And both of them, they became quite popular from, on SSR and are on the top downloaded list, and they're going to be probably, published. And the first one is going to be published in Journal of Banking and Finance. The second one is still under review. So the first one is R&R. Especially the first one, it became quite established after different revisions. The new revision came out last month. So I'm presenting the latest revision today. Both of them, they have the same concept behind them. So we are just focusing on large language models, and after that, time series foundation models, that the architecture is quite close to large language models. So they try to convert or change some of the properties of these models and architectures to match them with time series forecasting. In both of them, the target is exactly the same. We are focusing on excess return forecasting in US market for the first paper, but for the second paper, we are going to expand it to the other markets too as some robustness checks. So the concept is quite similar. The first one is we are developing large language models here, pre-training model. We are asking two specific questions. There are two motivations here for the first question. The first one is, do we really need really large models for forecasting return? So you see, a lot of papers every week, every month are coming out and showing, oh, chat GPT or GPT model, cloud model, all of them, they're reaching really high Sharpe ratios. So is it really essential to use substantially large models for return forecasting, or is it possible to develop a much smaller model and reach the same or better performance? So this is the first question we want to answer. And the other problem usually we have with all these models that are computationally intensive to pre-train is that they may bring lookahead bias or data leakage because they already saw the data until today, and when we apply it on the past data, last year, 2 years, maybe they already saw the data. So we can't trust directly the result it shows. The time I wrote this paper, it was like 2024. We didn't have any paper for this topic, look at bias in LLMs, but now there are many researchers coming and releasing their models that is like a point in time. And many of them still, they don't focus on, analyzing whether we have look at bias or not. They just say, okay, these are the models you can use to make sure there is no look at bias. So here we are testing that one because with decreasing the size of the models, it was possible for us to make different models or yearly models. We have the same concept for the second paper too. But that one is really, vulnerable to look at bias because those are time series models. And the companies, Google, Amazon, all of them, they are making their own time series foundation models or TSFMs. And all of them, they already saw the data. Maybe the financial data is inside of their corpus too. So that part is quite dangerous. But here, we're just talking about large language models that it's not really clear whether we have that lookahead bias or not. So these are the two important questions we want to answer here. So you are familiar with the development is in large language models. It's mostly started from word embeddings. After that, we have contextual language models like BERT, Roberta. We have larger scale transformers like GPT, Llama, or generative models. So we have many models. We try to cover both, as a benchmark, both popular open source LLMs in the market now, and also conventional models we have in finance for, textual analysis, processing text and written forecasting, use them here. So it's a really large set of benchmarks. So before moving to that one, in the paper, we have a really like a recipe how we can make large language models with the resources we have as a researcher. Because usually we don't have the, as access to the resources company they have on making these models. So it's really important to use high quality data and also make the models smaller, because when the models are small, it's not just about like the empirical side or practical side. Okay, you can use it in a trading engine easier, more convenient, and the other aspects like that. It's like we can apply explainable AI, we can do more tests with lower amount of resources. So it increases the number of questions or expand the number of questions we can ask when the models are smaller. So, and also it helps us to manage lookahead bias, make yearly models, monthly models, and when we want to like forecast next year, we just use the model that just saw the data until end day of the last year. So it kind of helps us to manage lookahead bias and also study lookahead bias. So the models are not that large, so we can do that. So data diversity becomes quite important. We have access to diverse amount of data in finance. What are the data sets, how we can have access to them, how we can process them, it becomes quite important because we want to invest more on data diversity compared to the size of the model. So model size and its efficiency becomes important. And also, what is the environmental impact? What is the cost of making these models? All of them, they become important factors for us. We try to see what data we have access to as academics. Companies, of course, they have more. But as academics, we found these sources as quite valuable for making a large language model. Key development data from Capital IQ. We had a contract with Dow Jones Newswires, SEC filings, Orbis IP for intellectual properties, ECB and Fed speeches, Capital IQ transcripts. All the transcripts are on the wall. Boardex data, all the information about historical profile of US board members. We know this data is not textual, so we made a system to convert it to textual data and feed it to the model we have for pre-training. And Wikipedia. Why Wikipedia? Because, okay, from the finance side, all these sources are quite important, but we need some general information too. But of course, we don't use the entire Wikipedia. There are different levels of the information there. Level 1, 2, 3, 4, they try to classify the document, the articles, they're based on their importance. So we choose level 4 because the coverage was quite good and the size was not really that much large to give more weight to the general information compared to the other sources we have. All the sources we have here are starting from 1997. Except transcript data that starts from 2005. Before that, the quality of data and the availability is not really good. So you see the size of data here, and if I think it's in million, right? Yeah, it's 7.2 million. And for the point here is that because we are using, making yearly models, the size of the model and the size of the data and the information coming to this model should be similar to each other as much as possible. So first, we set a target token size based on all data set we have. It's of course arbitrary, we can change it. For us, it is around 8.5 billion. And we try to monitor all this information. Some of them, at beginning, of course, 2007 is the first model we decided to make these yearly LLMs. As I said, starting from 1990, the information. And the size of data is not really high, so we need to oversample, and sometimes we need to undersample some of them to reach this target. And of course, for each data set, we give a weight to the whole data set we have. So like here, key information or key development data is covering 6% of our corpus. News is 36%. Again, these are arbitrary, but they are based on the size of data we have during time. We try to make some fair, set some fair shares of the data to make the corpus. But finally, based on the area you are working, based on the target you have, you can change this stuff, drop some of the data, or add the other ones. But finally, this gives us a really controlled way to control, the flow of the information coming to the models. And there is another thing that we have to be very careful about, that how we sample data, because we don't want to sample totally in the randomized way. Otherwise, the data coming to the models are going to be different. So the way we sample is quite controlled. It means if I want to make a model for 2008 and I want to bring key information data or news data, and I want to undersample or oversample, okay, we have the latest data, that's fine, that's the new data coming to the model, which is a part of it. But from the backward data, like the model is for 2008, the new data is from 2008, for 2007, 6, 5, For the model we have in 2007, it already used, or we choose some of the samples for that model. Now we are resampling from those selected or chosen samples. So we make sure the information coming to the model is going to be the same each year, except the new data coming to each model. That, of course, that's the new data, and we are free to choose anything we want from that new data. So again, we try to control the flow of information here to make it fair to compare these models with each other. Otherwise, they have different source of different informations inside of them, different size of, number of tokens inside of them. So it's not really apple to apple comparison. So the architecture we choose here is Roberta. Why Roberta? Because we didn't want a new model. We want to make a handicap model, but not really bad. Of course, Roberta is better than BERT. And there is another reason for choosing Roberta compared to the BERT model is that we don't have next sentence prediction for Roberta and pre-training. Many financial texts, when you check them, they are just one sentence, like headline of news or many other ones. So actually, we don't have any next sentence as a sample. So Roberta is quite matched for this, target. And of course, it's not state of art, but that's good, because if it works better than really state of art models, we can conclude that we don't need a state of art model for at least written prediction in this structure. So different sizes of models. Most of them are matched with their paper, so we didn't try to change anything except two things. So size of the models, we focus on base and small, 124 million parameters and 51 million parameters. Because those models, Roberta and Base, Roberta and BERT, they pre-trained them for really long epoch number, mostly like 40, 50, 100. And it's not possible to do that because we want to make yearly models here, not just one model. We try to decrease it to 5, but we have another test to extend it to 10 to see how it's impacting the performance. Do we really need to continue this process or not? But we have to be very careful. We have less amount of data than them. So it may not be that sensitive to this increase of number of epochs because we don't have that size of data they are using. So how much time it took? These were, we ran these models on H100 GPUs and A100. It's for like 2 years ago. And you can see for base model is around 679 hours. For the small model is around 385. But now these are single H100s and A100s. So now if you have more access, it's much, much faster. This is for 2 years ago. And how much electricity we consume for making these models. We reported all the details in the paper to make it really clear what is the impact, how much resources you need in a really, really, not really, advanced computational server, just H100 and A100 that are good, but single ones, not like a farm of GPUs. And you can see like around 325 kilogram of CO2 for all models based on models and around half for small models. So, okay, we have the models now. What data we are using? We are using Dow Jones Newswires for predicting excess return. And in Dow Jones Newswires, they tag data, and we just choose the news that are directly related to just one stock. From 2013 to 2016, we use it for training, and the results I'm presenting is from 2017 to 2023. We call the model we develop here FinTechs, but of course, we use other models here too. I'm going to show that to you. And we are presenting the statistical performance, and after that, portfolio construction performance based on zero net investment portfolio. Really simple, $1 long, $1 short, based on the predicted probabilities. So it is a directional forecasting, as you know. We use top 20% of the stocks for long and 20% of bottom for shorting. So these models, as you see, like Roberta and BERT, these are not generative models. We don't have any prompt engineering here. So the way we are extracting information is here. We are following the other research, I mean the Brian Kelly and Dodging paper that they have in expected return on large language models, which we decided to follow that strategy because some of the models we have here are like Roberta, BERT, and some of them are generative models. We can have like prompt engineering or asking prompt, and prompt is quite sensitive to the prompt you are asking the models, okay, what is the forecast for this one? You have to ask many times, and it's not really deterministic, but this way is quite deterministic. So the way it works is that we extract last hidden state embeddings by passing the text to each model, extract last hidden states embedding, and after that, okay, we have different tokens, and we calculate the mean pooling of the results, and easily we pass it to a logit model. So the model here is logit, but in the paper we tested 7, 8 different models, and still we found that simple logistic regression works very well, and the reasonings, everything is in the paper. So here I'm just reporting the main paper, but there in the appendix you can find say 10 models, different models we tested with the same architecture. So the logistic model for return prediction, the mean pooled of last embeddings is coming inside for each news, and the output is the direction of the excess return for the next day. So the window size is just 24 hours for all news coming to the market past 24 hours, and if we forecast the direction of the excess return for the next day. Different kind of models. This is the latest revision of the paper. The first version just covered Llama 1, 2, 3. Now we have many models: Mistral, Google DeepMind, Gemma, DeepSeek. We have FinBERT. We have FarmPredict, that is a statistical model for written forecasting based on text. And after, finally, we have like McDonald Dictionary and LMD. Oh, sorry. So go to the last page. So first, statistical results, classification results. We have yearly results, and also we have overall results. The first thing we see that most of the accuracies are close to 51%, 52%, and it's not statistically significant. These are the differences between model, whether it is statistically significant or not per year, and the overall. So statistically, they are quite close to each other, except FarmPredict and LMD that quite underperforming FinTechs. And when they are statistically different, usually FinTechs works better. So this is from the statistical performance from 2007 to 2023 and overall. But when we move to the portfolio performance, results becomes clear. So the first one is that the highest Sharpe ratio we reach is from FinTechs. Most of these models, they have around 17, 18, 19 billion parameters. The FinTechs we have here is just around 100 million parameters. So they are around 60 times, 50 times larger than this model. So clearly you see, in all cases, FinTechs is winning 3.7 Sharpe ratio, passing all of them. Equal weighted is better than value weighted portfolio, and it's expected, and it's consistent with the past research, because most of the alpha we get when we are trading with news is coming from the smallest stocks, low cap stocks. And that's the way it works when you are trading news. So for large cap stocks, usually the performance is not really good. And it's showing itself here. Equal weighted is much, much better than value weighted. As I said, it's consistent with the literature. And the other thing we see is that short side, when we are trading with news, is usually showing better performance than long side. This is quite consistent to when you are directly trading with news. And to be honest, the equal weighted better than value weighted is not a really good news, because it's, large cap stocks, of course, it's the cost and everything is much lower, and the liquidity and the other considerations. So in practice, we have to be very careful when we see these results, but even for value weighted, we are reaching proper Sharpe ratio. You see the cumulative log return here, FinTechs, and after that Llama, during time they are reaching the really high cumulative log return. Yes, Llama 2 is reaching better at end, but during time, if you check, usually FinTech is higher than Llama 2. This model, again, using much less data for pre-training, and also it is using much less number of parameters. I mean, inside of that, it's, as I said, the base size model is 100 million compared to 18-20 billion. You see alpha adjusted portfolio performance. In all cases, excess return is close to alpha, and R squared are really small. And again, it shows that the signal is not coming from the common factors we have from the market. We see the results after we include transaction costs. And again, most of the results, especially for equally weighted, are positive and statistically significant. And again, FinTech is beating the other models, or again, so close to other models. We see what happens when we change the model side. When we move to the base, to the small, the Sharpe ratio is decreasing, the long short. When we expected, model is smaller, but here we are actually talking about 100 million and 50 million when we compare them. They're not billions of parameters. It's much easier to even make these models smaller and get better performance. When we extend the pre-training number of epochs, you see the performance is here for the base model is decreasing. For a small model, it is slightly increasing, but after we include the transaction cost, it disappears too. So even continuing the pre-training when we have this size of data and all, architecture Roberta is not giving that much to us. So it opens again more, some doors for making our own model, because you don't need to continue this process for a long time with a small size of data you have. So we have many models. What happens if we move to use older models? All these horizontal lines you see here are the performance I showed you before, for the when we use it sequentially, because when we want to escape from lookalike bias, when I want to forecast 2018, I use the model from 2017. The results I showed you is like that, rolling window it this way. So we make sure there is no lookalike bias. But what happens if I just used an older model, like the model from 2010, and forecast all data after that, all the excess returns after that until 2016, because this is the last model we have before 2007. That's our out of sample data. As you see, from 2010, most of them, they are showing really good performance, and they are close to FinTech's rolling, the one that I used the previous year to forecast next year. So even we don't need to make many models. Even a model with older data, like 2012-13, is showing relatively good performance and close to the final model we have. At beginning, they are not really good because of those oversampling, because mostly at the beginning we have to do oversampling, and the quality of the data is not good too. But after 2010-11, one model works very well, and it's beating all those big players in the market, as you see. Lookalike bias. We did many tests, I don't want to open all of them. There are different layers of tests. The first layer is as language level, after that classification level, and after that portfolio level. We made a benchmark based on some prompts on probes. There are different, masking question, like this year, Bank of England was established in 2000 and something, or 1000, or 1980 something. So we asked these questions from these models, and okay, we can some thresholds, cuts that I passed the model for 2015 that just saw the data until that day, and the model should be able to answer most of the questions related to before this, and should not be able to answer the questions after that. So as you see, when we have our model, my models, in most of the cases, when it's really good in future probes, and it should be. I mean, it's really good in past probes, and it should be because the knowledge is inside of that, but it's not really good in future probes. It doesn't have any idea about that. This is for base, and this is for a small. So as is expected, the language, there's information is embedded inside of the model. And from the language side, we have lookup bias. There are some tests here after dimension reduction that you can see how, when we do dimension reduction based on the embedding we have from the Roberta for different years, how it is showing in two-dimensional environment. For some of the tokens, there is no pattern expected, but some of them there is, like COVID. You see after spreading the COVID, they are quite separated. Sunak, Trump, after Donald Trump ran for presidency, when we passed Trump as a token to the models and extract the embedding, for these models, it's totally separated from the other models. We have the same thing from Sunak, we have the same thing from Brexit. So information, again, is embedded into these yearly models. I don't want to continue this one. We have many tests in the paper. We move to the classification level. Interestingly, we don't see clearly any lookup bias there. So when after language level, when we extract the last layer of these LLMs and pass it to LLM, logistic regression, other models, it kind of disappears, this lookup bias. In portfolio level is again the same. As I said, based on this structure, based on this concept, we just have lookup bias at language level. It doesn't mean you don't have it when you are dealing with prompt engineering or you are passing questions to the LLMs and asking where does this stock return go. Here in this context, we just saw that in linguistic level, not classification and portfolio level. So it's not really threatening in this context, but it doesn't mean it's not threatening in the other contexts because it is there in linguistic level and it may go to the other levels too, but not here in this simple structure. The good thing that we can apply models like SHAP because the models are quite small. We can do more explainable AI stuff. We can see long portfolio and short portfolio here, what terms are important in each portfolio. As you see, short portfolio makes more sense than long portfolio, and we saw better performance of the short portfolio there, like petition, like resignation, you see all of them there, but long portfolio is so. So this is again quite matched with the performance results we had. So let's see, 25 minutes. I move to the next paper, but really fast. Sorry about that, but try to put both of them together. Revisiting time series foundation models in finance. So the story here is really computationally intensive compared to that one. There, we wanted to try make our test much smaller. Here, we opened the door. We spent 50,000 GPU hours for this paper, sorry. That, it was so much. And of course, it came from the government with the new server we have in the UK, Isambard AI. We had some early access for 2 rounds to test the server, but it helps us to make a paper like that. So time series foundation models is kind of a new term. There are many models coming from the big companies. One general model that can forecast everything with any frequency. They make these models in a way that they pre-train these models with a really strange mixture of the data, different sources, different topics, different frequencies. The same concept we have in large language models, that you can put a bunch of data together, pre-train the model, and model works well for any questions or any prompts or any query. Same concept here, but moving to time series foundation models. So the question here is that they have their own benchmarks. They're competing with each other. We in finance, we don't trust those benchmarks. Even in finance, they have benchmarks. We need to make, our case is not just a statistical performance. We want to focus on portfolio performance, economic impact. There are different layers here. They are promoting these models, but we try to understand whether they work or not. And after that, it's not the end. We try to use their architecture to make our own model with our own data too. So that part was quite computationally intensive. Again, per year, one model. Here, the motivation is clear. This is the time series data. The model should not see the future data. We have to do that. Otherwise, we may have, definitely, we have lookout bias. So first, we test their model in zero shot, fine tune, and after that, we pre-train our model. The context is quite simple. Most of these models are univariate. We just focus on different window sizes. 5 days, 1 month, 1 year, and maximum 512 days of past data to forecast excess return. One model for entire market. So for each year, we make one model based on all data we have in the market, US market, entire market, all the markets around together, 89 markets. We make single models per year. And this is the structure. So univariate and quite, large scale. 2 models for pre-training, but we extended this analysis to more models for zero shot because it's quite computation intensive. There are 14, 15 architectures here. Kronos and TimesFM. Kronos from Amazon, TimesFM from Google. I don't want to open the architecture and everything. You can read the paper and their paper. But these are kind of the first models that made some hype in the market that we can make a single model to forecast everything, and the performance is really good. You see the difference here. Of course, we have a group of proper benchmarks here, and you can see the NERMs here from OLS, Lasso, Ridge, ElasticNet, Neural Network, PCR, Light, GBM, XGBoost, CatBoost, many. And to be honest, we spend so much resources for them too, but CPU cores. And you see the change in the size. When we move to the models we have from TSFMs, we have sudden increase in size of the models, around 500 million. Now we have models with 7-10 billion. Some of the models they came last week from called Toto. There are a few billions. We tested them too. So this is the size in lower scale, and you see the difference. But do we really need this size or not? So high computational cost, data intensity, we have this stuff, and we want to consider studying these models. It's really challenging to manage it because you need a lot of computational resources. As I said, we use 50,000 GPU hours, H100, GH200 for this one. For pre-training, near 400 Kronos model and near 300 TimesFM model to do all the tests we have. And of course, we use a part of it for testing these models too, zero shot and fine tuning. The case is quite simple. All excess returns together, past history of excess return, daily forecasting to forecast next return for different window sizes. Similar to the previous paper. In the previous paper, it was 1 day, but we have more data. Really simple. Why we have this one? Why we don't have multivariate? Because these models, most of them are univariate, because LLMs are univariate models, So they are inheriting their architecture, and these are univariates too. So much data for estimation, many type of the models. We started from US data. After that, we moved to the international markets. 89 countries, the data, they come together to make a single model per year. And you see the number of observation and securities here in thousands. For all markets, we are reaching 496,000 observation. It counts in thousands. And for securities, it's around 204,000 securities around the world for the model we developed for 2022. The first model we have starts from 2000, and the last model starts from 2022. And from when we are starting, using the data for pre-training from 1990, and you see here historically how much data we have for excess return from different markets and total together. Before that, the quality of data, is not good, and also the size of data. So we choose 90. Data point securities. So this part is for starting from pre-training, and after that, our data starts. The first model is 2000 for forecasting 2001. We use the model for 2001 forecasting 2002 until we reach 2023. Evaluation data first, all the results I show for US market, it's around 10,000 securities and 18 million observations. So it's a really large scale test here. Many benchmark models, we talk about that. Setting a good, proper benchmark group of models are important. We are not comparing TSFMs against each other. We are comparing them with a really strong group of benchmark models. Again, evaluation metrics, R-squared classification results, and portfolio results, like before, zero net investment strategy. You see the results here for portfolio really fast. The best model is coming mostly from this group, XGBoost, CatBoost, Light GPM, and it's expected these are really good performing models. The Sharpe ratio is around 6, and a statistical performance is showing the same results. I didn't present it here. Different window sizes, 512, 252, and 512, because usually this is the maximum number of tokens we can pass to those time series foundation models. So we chose CatBoost here as the best performing model, longer window size, generally better performance, but after 252 usually it's stable, it's not adding that much information. Zero-shot performance of different models, Chronos and Times FM. Most of them, the Sharpe ratio is negative. Some of them, it is positive. This benchmark is actually CatBoost, and all of them underperforming a simple CatBoost model. This is the first alarm or danger we see here. Don't trust benchmarks in the market. Try to test it in your case. And they are really dangerous in practice, as you see if you use them. So we go ahead, we tested more models, Bold, Times FM, Moment, Toto, Sundial, all of them, they are showing the same thing. Some of them, they are promising, like Toto, Laglama, Sundial, but it's still underperforming the simple, model we had as benchmark. So again, zero shot, promising, but it's not there. We need to work more on that. Fine-tuning was the other thing we did. I am not presenting it here, didn't improve the results. So the promise that you can fine-tune these models and get better results, no, it's not there. We pre-trained the models, and models started showing some promises. Still, as you see, when we check the Sharpe ratio, it's not competing with the CatBoost model we have, but at least they are not negative, and some of them they are quite close, as you see here. So it means the architecture is good. It may work, but one model for doing everything is not working. We have to be very careful. We need so much resources to do that. For pre-training these models compared to even CatBoost is quite computationally intensive, as you see, the best performing one. But these are more, and here we need GPU. Here we can do that on CPU mostly, but high number, of course. So we have to be very careful. We are not reaching that performance. We have in benchmark, and they are really computationally intensive. Really fast, in 5 minutes, we expanded this idea. We use the results I showed you came from the US data for pre-training the model. We use entire global data to make in these models too, because the promise is that you need so much data to do these models, to make these models. Their performance improved, but it's still not as competitive as benchmark models. But we have to be very careful. Benchmark models, when we use more data with the same architecture and the size, the performance went down. But because we have higher capacity or larger number of parameters or complexity in these time series foundation models, when we added more data for pre-training, they improved the performance. After that, we extended more. We added JKPay factors to these models, all the factors we have from financial reports around the world for all companies. They are monthly, yes, but that's the promise of these models. Mix everything you have and make a single model. Did we see any improvement? Not really. It didn't help that much. Slightly, but not that much. We switched JKPay factors with synthetic data, especially, and we found similar results mostly. So just blindly expanding the data size like they are proposing, even if we are in the same area in finance, it's not really helpful. It is better to try tune these models in different ways. All the models during time, as you see as an example, all the results are in the paper. These are Sharpe ratios for different models for different window sizes. The other thing is that, as you see, for time series foundation models, these models for short window sizes, they don't work at all. And we have to have longer window size for make the models working. The same thing we have in large language models. When you are passing a really short question or not providing that much information for these models, they don't work very well. When we have more information, they start working. But we don't have the same, problem with conventional models like CatBoost, like GBM. Most of them, they are close to each other. And of course, more data brings better performance, but it's not like that. During time, as you see, all of them, the performance is going down. So at beginning, if you were using all these models in like, I don't know, 2004, 2005, we are getting really high Sharpe ratio. But recently, all of them, they are, close to 0, 1, 2, something like that. And this is the thing we expect, that most of the, traders, hedge funds are using these models. So the alpha we have in the model, the information we have in the market that these models can extract is going lower and lower. But we have some fluctuations during time too, as you see. Finally, last 3 minutes, the other thing we tested was hyperparameter tuning. We keep the data size as minimum as possible, just US data, and we try to play with hyperparameters, because at the beginning we try to use the hyperparameters they propose. And we found that when we start tuning these hyperparameters, we can reach better performance without increasing model size or increasing the size of data. So again, we come back to the same point. These models are like the other models we have. We can make a single model to forecast everything. But the architecture is promising. If you try to tune it, more data, they are really good to process more data. With tuning, you can reach better Sharpe ratios in the market and passing the benchmark models you have. So this is promising, but the architecture is promising, not as the way they are advertising about these models. It's better to move to the architecture, not making a single model to forecast everything. We applied the same concept on different markets as robustness checks: Hong Kong, Taiwan, Korea, India, Australia. That world model, I mean the global model, we apply to forecast the entire stock markets again from 2001 to 2023 for different markets, and generally we reach the same outputs. Again, gains are stronger in large liquid markets with longer data histories, and mostly it's showing mirroring the US evidence. So it was here we talk about the key messages here, that still the benchmark models like CatBoost, like GPM, they works very well, but there is room to improve these models. So one of the things I got so far, I have been presenting, especially this paper, for many hedge funds and investment banks. They are quite interested in this research because they try to use new models, but it needs so much working and time and resources to make these models running. So it's not a really easygoing research topic, but if you have access to resources, and the future path is mostly tuning these models for financial forecasting, not making a really large model as we showed here. And you can see the website, fintechs.ai, GitHub, Hugging Face, podcast, everything is under fintechs.ai. All the models we develop in the second paper. Sadly, the models for the first paper, because of some problems we had with some of the companies, major AI companies, they are not available anymore. I made them public at the beginning. There were many downloads, but sadly, they pushed me to stop releasing the models. So, but for the second paper, hopefully so far they are out and you can test. I'm not telling they work very well. Of course, there are many problems in these models, but it's good to test, see how it works. They work in different topics. We are focusing on that. Okay, thank you so much. I think I finished on time. So if you have any question, I'm here.
Thank you very much, Eghbal, for a very interesting and informative presentation. So now we have time for questions. Please feel free to either raise your hand or type your questions in the chat or Q&A. So we have a question from Jamshid. Feel free to unmute your microphone.
I can't hear.
Yeah, Jamshid, you're muted.
I think he's trying to figure out his mic. Maybe someone else can go first.
Yeah. I can probably ask a kind of general question. So you're in finance and you're, targeting finance journals and some related banking or econ journals for your research. And you were saying that you went through several, R&R procedure and, preparing probably some sort of, additional evidences for the community. Could you tell us more about their main expectations and concern for this sort of interdisciplinary works, including, large language models?
I mean, yes, it depends on venue. It's really difficult to give a clear answer to this one because I got many inconsistent, feedback so far. But in general, if the target is finance, I mean common, proper finance journals, the main concern is that, how much we focus on the computer side. Usually, we have to minimize it or pass it to appendix and mostly focus on the message in finance. Here at beginning, the last version I had bunch of information about LLMs, how they work, and how we are using these models. But in the new version, I minimized that and moved the most of the focus on portfolio, risk-adjusted portfolio. What is the key message there? What is it showing to us compared to conventional financial models? And this is really important. The reason you see in all papers, I have even linear models. I have OLS, even in the second paper, the forecasting model is quite simple, like just logistic model. So we have to keep my understanding, again, depends on the venue, that the framework as much as simple, minimize the computational or computer science side, translate it to more mathematical stuff. When we want to describe LLM, we can have a fancy plot that's showing data is coming inside, this is output, but this is not working. We can have a simple equation like the one I have in the latest version that, okay, these are the hyperparameters, the input is text, and this is the output. This is more acceptable for them when they look at, especially the first version. The most dangerous thing I found is that they feel somebody from computer science is writing the paper, and this like trigger for reviewers or editor that, oh, this is computer science, this is not for finance. Even if it is good, they don't continue reading that one. This is my understanding so far, that everything as much as possible should be translated to a really common language we have in finance. It's really difficult to reach that point, because when we talk about LLM, most, big part of that is about computer science, about how fine-tuning works, how pre-training works, but these are not the target, the financial question is the target.
Yeah, interesting. I think this is actually the thing that we have seen before for the projects related to AI machine learning in general. So I've seen sometimes that you can probably add a kind of pseudo algorithm to summarize all those
Yeah.
technical steps, like in just one figure. And then,
Yeah.
as you said, I would love to see some sort of equations
Yeah.
summarizing the entire process. That was a great hint for us, as in at least in our research lab, we are usually target those journals in multidisciplinary, but mainly in finance and econ.
Mm.
I have one question.
Go ahead.
Yeah.
Yeah. Thank you for your presentation. It's really interesting. Uh, My question comes to a little bit micro in your results. Did you see any correlation or similarities between the assets that different models choose to allocate in the portfolios and also in their weight?
Mm. To be honest, I didn't test that one because we have many, the paper is already 130 pages. We try to still make it shorter because it's a really large scale test, many models, many tests. We didn't try to do that. That's a good, interesting question to see how these models are choosing different assets at the portfolio level. But at this, stage, we didn't test this one.
Yeah, I think it's interesting because um, the way they recommend different assets, if they converge together, they
Mhm,
have different area of research, or they offer different assets, but they work on their weights
mhm.
to have the good results for portfolios. I think these two branches can have can open different research questions for the future.
Yeah. I mean, especially for LLM one, it's
Yeah.
more, it's easier to do that. The problem with time series foundation models is that we have many models. The area is not that established. But for LLMs, when we talk about Llama, when we talk about the other models, these are the established models in the market. But in TSFMs, everything is changing so fast. New versions are coming. It's really earliest stage for doing this test, But I agree with you, for the LLM side, it's possible. But you have to be very careful because and not moving to the area most of the people are moving to that, like prompt engineering, passing something to LLMs, asking where this stock is going. These are not really genuine ways. Usually people, in practice, they do for trading. And we have a serious problem of lookout bias here. This is really important to consider.
Yeah, I was interested in that area because I want to see if these platforms think in the same way in choosing the assets or think the same way in optimizing the weights. That's what I was asking.
Yeah.
How they're
So you have
different
to move
they're
to
in thinking.
something like the way we have or the other papers they have. Don't play with the prompt engineering. Focus on the weights and the information inside of the model. Yes, you are losing some information there when you are just passing all those weights, averaging, passing to logistic regression. But if there is an signal there, even after these dimension reductions you have and you get it, it means there is something there.
Yeah, especially um, in that case, maybe we can find that the platforms, which one is weaker in optimizing the weights, which one is weaker in choosing the assets.
And
In that
open
case,
source
and
models,
then in the
definitely.
next step, we can
Yeah.
select another another complementary method to add to your methods and
Yeah.
decide in order to improve their performance. That's why I'm
Yeah, I
asking.
mean, I will
Thank you.
report, especially for the first paper, we reported all details. Everything is there without any exception. You can find out exactly about hyperparameters we choose, the cost, the details, the steps. You can change. And again, it's like a recipe for the others to use, a really simple recipe for academics to use open weight models for their research.
Thank you.
Welcome.
Hi. Um, Thank you for your presentation. Yes, very interesting. Um, Especially there was one plot near the end where you show sort of the I think it was like the edge of the portfolio, over time. And the plot showed that that edge is basically disappearing over
Yeah,
the past couple of years. Um,
yeah.
I was wondering if maybe that is slightly it might indicate that LLMs might not be as useful in the future in this specific use,
Mhm.
maybe, what are some other uses that LLMs and, in general, language models might have still in finance?
Mhm. It doesn't matter what model you are using. One model comes, all trade, most of the traders, quants, they start using it. They become established in their system and the alpha goes away. It doesn't matter. This is LLM, this is neural network, and this is other thing. The conventional models, when we directly use them, they try to degrade during time. And after that, they start to bring some innovations inside of the model to keep them running. So now I think the structures like this, directly using a model for trading, this is first step. After that, it moves to improvements. So probably if we come back, apply the neural networks from 10 years ago and see, we did it. And neural network at beginning, when, from 2004, 2005, simple, fully connected neural networks was working very well. But now it is not. It doesn't mean neural network is not working anymore. It means a simple neural network with a conventional structure was better performing at the beginning, and that's expected. And during time, the performance is going lower. A part of it is coming from the, more people are using these models. But of course, there are other reasons behind that too, about the data in the market, the size, the market, impact, the size of the market. There are different things, but a part of it can be this one. But as I said here, when we talk about LLMs, when we talk about time series foundation models, we talk about conventional models we have. There are so much room for improving these models. And that's the way hedge funds and investment banks, they try to do. They don't make a new model every day. They try to improve their architectures they have during time to keep the momentum.
So it's kind of an outrageous question because it's very difficult to answer. But you unless there's a huge breakthrough in some, in either computer science, whatever, that's sort of like the way that you see, hedge funds, mutual funds moving forward. Just like at the moment, they're focusing on
Not
improving these
all of
models.
them, really quant ones, it's so rare. When we talk about quant finance, it's a really general term, but
Yeah.
all part of it are using really advanced models. And yes, they try to use it, they try to gain something, and after that, they try to improve it. So yes, we have my understanding, some jumps in the market in performance, that we have some breakthrough like LLMs now, few years ago, other models. This is a big one, of course, during last decade. They try to use it, and after that, it degrades.
Thank you. Thank you so much.
We still have time for a couple of more questions. We also actually have a few questions from those who registered for this event, but surprisingly, none of them are showing up in the Zoom. Hopefully, the invitation email didn't went to their spam folder. But generally speaking, they were asking about like the interpretability of the LLM models, the difference between small language models and large language models. And we also have a question which is asking you about like the job market for future graduates looking to work in the finance sector.
Okay, yeah, that's both of them are good question. The first one, I described a bit. You have to forget to make the open weight models in the market now interpretable. Yes, we have some models like SHAP or the other models we can bring some interpretability, but with the size of the models they have, I tried, even the smaller models, when you reach something like billions of parameters, computationally, it becomes impossible to have a really simple methods apply to those models to make them interpretable. So the only way we can with the fair amount of resources, bring some levels of interpretability to the models, is moving to a small large language models and making our own model. This is the path I found. Of course, if you have a farm of GPUs, probably hundreds of GPUs, you may be able to do that, but it's not really that feasible. So one of the reasons to move to a smaller model is actually making the models more interpretable. I try to do it a bit. I showed you the plot for long and short portfolio, the terms the model are choosing, but it's just possible with these smaller models. I tried to even do that with the simplest model I had, and clearly it's not feasible with even 50 GPUs, 100 H100 GPUs. It's not really computationally intensive. For now, maybe in future it becomes definitely better. The algorithms, the models, everything becomes smaller. Now the trend in the market is that making more efficient and smaller LLMs too. But the game is still in the billions of parameters. When we move to billion, it's really difficult to make these models interpretable. Yes, there are some methods outside, but not easy to apply or not really trustable, the results we get. For the next question, it's difficult. Now, with anybody I talk from the investment banks, hedge funds, markets, the market is quite foggy considering the AI. We have the same problem with tech companies too. When I talk with the people in Meta, they are confused too. Microsoft, they are confused too. Many groups, they are doing the same thing at the same time, and they shuffle, people, and they try to. We see the redundancy came from Meta. Again, they may hire, they may fire. So it's really difficult to say what's happening, what's going to happen, but the confusion is in the market. The promises we had before and we expected from these models and this technology in general, it's not as expected. So from the application side, it doesn't matter whether it is in finance, whether it is in tech and other things. And it's so even they don't know. So the signal I get from the companies is that even their senior managers, they don't know where it is going. It's really confused market, foggy. And I think the main thing people, when they want to, even me, I'm doing, is that the skill set and the real skill set, not vibe coding. Vibe coding is just some tools to help us, not replacing a coder. The problem is that when you rely so much on this stuff, you lose your own skill and you become dependent. It's like addiction finally, that gradually your skill is going down. When I want to write the code, I start writing code myself. But of course, it makes my work faster. When I write paper myself, but I try to make it better with these models, not replacing myself with them. Later, the people, they are to make everything faster, they try to replace themselves with these tools. They become seriously less competitive in the market. This is my view. Maybe it is wrong. This is the thing I see.
Any other questions? Cool. So thank you again, Eghbal, for this fabulous presentation and for your time and for joining us today. And thank you everyone for participating in this speaker series. And we would love to see you again in our upcoming events. And we would also love to have you more like in our weekly meetings or even conduct some joint research. So we do have researchers at DLQF who are working on agentic AI and large language models, but they are trying to narrow down some topics and to come up with some more concrete ideas. So we would love to share those with you, later on and get your feedback. Good. And I think we can wrap up our meeting. And is there any other things that you would like to add before we end our meeting today?
No, thank you so much for the invitation. It was a great experience. Thank you.
Thank you, indeed. And everyone have a great rest of the day.
Thank you all.
Bye.
Bye.
Thank you so much.
Thank
Thank you.